Prices went up quickly in 2021 and 2022. Groceries, rent, fuel, electricity. Almost everything became more expensive. Then something interesting happened. Inflation started to fall. Governments announced progress. Central banks raised interest rates. News headlines said the worst might be over. But many people noticed something strange. Prices did not go back down. Groceries were still expensive. Rent was still high. Eating out still cost more than it used to. And that raises an obvious question. If inflation is falling, why don't prices fall too? At first glance, it seems like they should. If prices rise when inflation is high, then logically they should fall when inflation drops. But that is not how the system works, and once you understand why, you begin to see something important about modern economies. Prices rarely move backwards. They move slower. They stabilize. Sometimes they stop rising for a while, but they almost never return to where they were. Not because companies are evil, not because economists are hiding something, but because the system has incentives that push prices in only one direction. To understand this, we first need to clarify something most people misunderstand. Inflation does not measure how expensive things are. Inflation measures how fast prices are changing. And that difference explains almost everything. Once prices rise, something interesting happens. They tend to stay there. Economists call this price stickiness. In theory, prices should move both ways, up when costs rise, down when costs fall. But in practice, that almost never happens. And the reason has less to do with greed and more to do with incentives. Consider a simple example. A restaurant increases its menu prices during inflation. Food becomes more expensive. Energy costs rise. Staff wages increase. So the restaurant adjusts its prices. Now imagine those costs begin to stabilize. Does the restaurant lower its prices again? Usually, no, because lowering prices creates a different kind of risk. Customers quickly notice when prices fall, but more importantly, they remember. If customers start expecting prices to fall again, they delay spending. They wait. And waiting is dangerous for businesses. Revenue becomes unpredictable. Planning becomes harder. Margins shrink. So instead of lowering prices, companies usually do something else. They leave prices where they are, even if their costs improve slightly. Another reason prices stay high is something called menu costs. Not just literal menus. Every time a company changes prices, it must update systems, retrain staff, adjust marketing, and communicate changes to customers. Those changes cost time and money. So businesses prefer stability. Once prices rise, keeping them there is often easier than constantly adjusting them. But there is an even deeper reason prices rarely go back down. And it has nothing to do with restaurants or supermarkets. It has to do with the way modern economies are built. Because modern economies depend heavily on one thing: debt. Modern economies depend heavily on debt. Mortgages, corporate loans, government bonds. Almost every large system in the economy runs on borrowed money. And debt behaves in a very particular way. It becomes easier to repay when prices rise. Imagine someone who borrowed money 10 years ago. If wages and prices increase over time, that old debt becomes easier to manage. The money used to repay it is worth less than before. But the opposite is also true. If prices fall across the economy, debt becomes heavier, harder to repay, harder to manage. And when that happens, entire financial systems can become unstable. Businesses struggle to service loans, governments collect less tax revenue, banks face higher risks. This is why central banks tend to fear one thing more than inflation: deflation. Deflation is a sustained decline in prices across the economy. At first glance, it sounds positive. Cheaper goods, lower prices. But widespread deflation can cause something dangerous. People begin to wait. If you believe prices will be lower next month, you delay spending today. And when millions of people delay spending at the same time, economic activity slows down. Companies sell less, production slows, jobs disappear. So most modern monetary systems aim for something very specific. Not falling prices, not even perfectly stable prices, but slowly rising prices. A small amount of inflation year after year. Because a system with slowly rising prices keeps spending moving forward. It keeps debt manageable, and it keeps the economic machine running. Which brings us back to the question we started with. Why do prices rarely go back down? Not because someone secretly decided they shouldn't, and not because companies refuse to lower them, but because modern economies are designed to move forward, not backward. Prices may stabilize, they may rise more slowly, but the system itself resists reversing direction. And once you see that pattern, a lot of things begin to make more sense. Because sometimes the system is not malfunctioning, sometimes it is behaving exactly as it was built to behave. You just have to look closely enough to see it.